Every day, we go to work, earn money, and get paid through our bank accounts. If we want additional income from our idle money, we open savings accounts, also at a bank. When we need extra money for personal needs, such as consumer spending, buying a house, or buying a car, we also go to the bank. Conversely, many of us are now thinking about buying stocks or even bonds to indirectly invest in banks. But have you ever wondered how banks actually make money? Let's explore this together. One point I want to mention here is that the entities I'm referring to in this video are commercial banks, not central banks, policy banks, or investment banks. The Federal Reserve, for example, is the central bank of the United States, which is not in the business of making a profit. Investment banking involves institutions that focus on investments. If you've seen my video explaining the 2008 financial crisis, you probably know who they are. They act as intermediaries, connecting those who need money to those who have money, and they also provide consulting services such as M&A advisory, IPO advisory, and bond issuance advisory. They do not accept deposits from the public. Commercial banks are what you see all around you, such as Bank of America, Chase, Wells Fargo, and so on. In this video, I will discuss the main sources of revenue for a bank and the main expenses a bank has to bear. From there, you can subtract revenue from expenses to get the profit of a bank, right? I will also explain it in reverse. For example, if a bank suffers a huge loss because they engage in illegal lending, what problems will they face? Will they go bankrupt? And if a bank goes bankrupt, what will happen to us? Okay, let's start. Before we find out what a bank's main sources of revenue are, can you imagine who the bank's customers are? Typically, they are divided into two main groups. The first group is individual customers, like you and me watching this video. The second group is institutional customers. This group is further divided into two smaller groups: financial institutions and ordinary businesses. Financial institutions are credit institutions, such as other banks, insurance companies, and financial companies. The second group in institutional customers is businesses. This group is further divided into smaller groups, such as large businesses, medium-sized businesses, small businesses, newly established businesses, and foreign invested businesses, depending on the specific bank. For individual customers, banks offer services such as opening ordinary payment accounts, savings accounts, debit cards, credit cards, loans, insurance, and money transfer services. Recently, they have also added services such as stock and mutual fund investment through affiliated fund management companies. Personal loan products include consumer loans, real estate loans, car loans, business loans, and student loans. For institutional customers, banks provide services such as credit, account management, card services, foreign exchange services, and insurance. Foreign exchange services involve providing services for buying and selling foreign currencies, spot or forward, as well as guarantees. They also provide insurance services and investment management through affiliated companies. Business credit includes short-term loans, working capital loans, and financing for large and small projects. I've listed all of this to help you visualize how diverse and complex the operations of a bank can be. It may sound complicated and confusing, but in reality, the most important activity that generates the most profit for the bank is credit. Credit means lending, right? The word credit emphasizes the element of trust. It means trust, and it is the foundation for the operation and development of the finance industry. How does this work? We, the individual customers, need a safe place to keep our money, right? Other than storing it at home, where we risk being robbed, where can we keep our money and earn interest? Obviously, banks are one of the most trusted options. We believe that banks will repay us on time and in full, right? Conversely, when banks lend to us, or to large businesses, tens, hundreds, or thousands of millions of dollars, they also fully trust that they are lending to the right person and that they will continue to do business, generate profits, and repay both the principal and interest. It's entirely based on trust. So how do banks make money from lending? The answer is simple: from the interest that borrowers have to pay. The source of funds that banks can lend comes from our pockets, from the money you and I deposit into savings accounts or current accounts at the bank. Let's put ourselves in the shoes of a depositor. For example, if I go to Chase and deposit my money at an interest rate of 1% per year, and the bank uses that money to lend to someone else at an interest rate of 4% per year, then the bank is earning 3% per year. That's the profit they earn. If we put ourselves in the shoes of a borrower, someone who borrows from the bank at an interest rate of 4% per year, the worse our ability to repay the debt, the higher the interest rate on our loan will be. Banks have to charge higher interest rates for those with a higher risk of default to compensate for that risk. Now, to help you visualize how much profit banks earn, I'll give you an example. Suppose Mr. A wants to buy a house. He needs to borrow $500,000 for a 30-year term. To make it simple, I'll take a fixed interest rate of 4% for the entire 30 years. The principal and interest will be paid monthly with a fixed principal and decreasing interest. If we calculate the total interest paid over 30 years, Mr. A will have to pay $359,000 in interest, with a total of principal and interest of nearly $859,000 after 30 years. And that's just one borrower. With millions of other borrowers with different needs, banks earn a lot of revenue from lending activities. If lending is the most important activity for a bank, it's obvious that they need some sort of indicator to measure the efficiency of this activity and to compare banks with each other, right? There is such an indicator, and I want to present it to you in this video. It's called NIM, net interest margin. The reason I'm sharing this is because I see this indicator mentioned quite frequently on TV, and it's also very special and unique, only applicable to the banking industry. Back to the example we just discussed, you can see that the bank earns 4% from Mr. A's home loan using Mr. B's savings. The bank has to pay 1% interest on savings, so this 3% difference is the bank's profit, which they call NIM, net interest margin. It is calculated by subtracting the interest paid on deposits from the interest earned on loans, divided by total assets. Banks try their best to keep the savings interest rate as low as possible and raise the lending interest rate as high as possible to achieve the highest NIM. Not to mention, the amount of money deposited into payment accounts is a source of cheap capital, almost free for banks to operate. Let's say 0% to make it easy to calculate. If we replace 1% with 0%, you'll see how much more interest banks earn. However, I also want to note that the 3% NIM is not entirely profit that the bank can earn, because they have to pay many other expenses besides the main expense of the cost of funds, which is the 1% interest paid to those who deposit money into savings accounts. These other expenses include staff salaries and expenses related to credit operations, including appraisal, credit approval, credit disbursement process, and post-credit management. Now let's go back to Mr. B's perspective. Mr. B deposited $500,000 in the bank. The bank took those $500,000 and lent them to Mr. A for a 30-year term to buy a house. Now, if Mr. B wants to withdraw that money, can he? Actually, Mr. B can withdraw his money at any time. Why? Because all commercial banks are subject to a regulation called reserve requirements. You can simply understand that commercial banks must keep a certain amount of cash on hand that they cannot use for lending or any other purpose. This is a mandatory requirement from the Federal Reserve. For example, if you deposit $10,000 into a bank and the reserve requirement is 10%, it means the bank can only lend out $9,000. They have to keep $1,000 in their vault at the Federal Reserve. This tool allows the central bank to manage the money supply through monetary policy. For example, if the Federal Reserve sees that there's too much money in the market, they will increase the reserve requirement to force commercial banks to deposit more money with them, thereby reducing the money supply in the market. However, I also want to note that the reserve requirement is not very high, so if a few people withdraw money from the bank, there won't be any problem. But if all of us withdraw money from the bank, it will become a disaster, because no bank has enough money to pay everyone back. Only a small percentage of the world's money is in cash. The rest is in accounts, which is virtual money. You probably now understand that lending is the biggest source of profit for a bank. Simply put, you deposit money into a savings account at the bank takes that money and lends it to someone else at a higher interest rate, and they pocket the difference. So besides lending, can banks make money from other activities? In reality, all banks understand that lending is the most important activity, and they have to focus most of their resources and efforts on generating the most profit from it. However, they cannot lend as much money as they want, and to whomever they want. They must be regulated by the central bank, because if the central bank does not intervene and regulate these activities, there will be unresolvable consequences, potentially even a systemic collapse. Therefore, banks are increasingly seeking to earn money from non-lending activities, which they call non-interest income or fee income. Firstly, it's fee income, including money transfer fees, ATM withdrawal fees, credit card issuance and maintenance fees, electronic banking service fees, SMS fees, insurance and guarantee fees, and late payment and early repayment penalties. If anyone wonders why they have to pay penalties for early repayment, try to see it from the bank's perspective. Going back to our example, if you are the bank, you receive $500,000 from Mr. B and lend it to Mr. A for 30 years. You expect to earn over $359,000 in interest, but suddenly Mr. A comes in the third year and repays the entire principal. Now you face a cash flow imbalance. You were supposed to receive a significant amount of money over 30 years, but now by the third year, you're not earning anything from Mr. A anymore. You still have to pay 1% interest to Mr. B, so now you suddenly face an imbalance. You're forced to penalize Mr. A for early repayment to give you time to find other lending opportunities, right? So it makes sense. Not to mention, all penalty fees are stipulated in your loan agreement when you sign with the bank. You should read the terms and conditions carefully. If you repay your loan early, you will be subject to certain penalties. However, some banks are quite lenient with early repayment penalties, and some even waive them after a certain number of years. Among the bank's fee income, there is a special fee called interchange or card payment fee. Have you ever noticed how Visa or MasterCard make money? Actually, they approach banks and ask them to issue Visa and MasterCard debit or credit cards, platinum, standard, or co-branded with airlines, whatever they want. They then issue these cards to the public. When people use these cards at merchants, for example at small grocery stores, they swipe or tap their card on the POS terminal, and the merchant, not the consumer, is the one who pays the fee. The merchant pays around 1.5% to 1.8% of the transaction value to the issuing bank. The issuing bank then keeps a portion of that fee and pays the rest back to Visa or MasterCard. You can imagine how much money Visa and MasterCard make, collecting fees from every transaction in every country around the world. It's a huge amount. Back to our story. It's a bit funny, but during the pandemic, we shifted to a cashless society, right? We make online payments, use e-commerce, and tap our cards. As a result, card payment fees have become a significant source of income for banks, especially in times when it's difficult for them to generate interest income. However, it's not always good for merchants, especially small grocery stores or convenience stores, because they have to pay a significant amount of money in fees for each transaction. That's why many merchants used to refuse card payments and ask customers to pay in cash. It was their way of saving some money during those difficult times. Besides fee income, banks also earn a considerable amount of money from other business activities such as foreign exchange trading, securities trading, credit card late fees, and insurance sales. Lately, there have been many stories about customers being forced to buy insurance by bank staff in order to get loans. This is one of the ways banks can earn extra income during times when they're struggling to generate interest income. To gain a more realistic perspective, I'll show you the financial statements of two leading banks in the USA, Bank of America and JPMorgan Chase, to see how they actually make money. First, let's look at Bank of America. Here you are looking at the income statement of Bank of America for 2021. Typically, income statements show us which activities generate the most revenue, starting with the most profitable at the top, followed by less profitable ones below. Finally, they deduct expenses to arrive at the profit. We can see that interest income, meaning income from lending, is around $58 billion in 2021. The interest expenses, which they pay to depositors like Mr. B, are over $8 billion. They also earn profit from other activities, such as service fees, which is over $8 billion, foreign exchange trading profit of $2 billion, and securities trading loss. Their net profit from other activities is around $10 billion. They also paid a substantial amount of tax, over $5 billion. And finally, their net profit for 2021 is $32 billion. Now, Let's look at the financial statement of JPMorgan Chase. You'll see it's quite similar. In 2021, JPMorgan Chase issued loans worth $48 billion and incurred loan expenses of $12 billion, resulting in a net interest margin of around $36 billion. Note that this is a simplified NIM calculation. The actual NIM is more complex. I'm just giving you a basic formula. JPMorgan Chase also earned over $20 billion from other activities such as foreign exchange trading, securities trading, and investment income. Their operating expenses were around $20 billion, and their provision for credit losses was $4 billion. So why are there different credit risk groups? Let's go back to Bank of America's financial statement and look at Section 9, which is loans to customers. You can see that the total outstanding loans, which is the total amount of money lent in 2021, is $961 billion. This figure falls into the category of loans that meet standard criteria. This means Bank of America is doing a great job at lending. Almost all of their loans are classified as Group 1, which is the best category. You can see here that people often use the term bad debt when referring to banks. Bad debt refers to loans in Group 3, Group 4, and Group 5, meaning substandard loans, doubtful loans, and loss loans. Loans with potential loss of principal are the worst kind of loans, and they amount to $44 billion. What does Bank of America have to do with this amount? They need to set aside a provision, meaning they put aside a certain amount of money to prepare for the possibility that those borrowers default. Lending is a risky activity. Even lending to your friends, you might worry about them not repaying you and losing your money. Banks need a system to manage that risk. They assign a score to each borrower, like grading students, where A is the best and C is the worst. Banks categorize borrowers into different credit risk groups based on regulations from the central bank. If they lend to someone who falls into Group 5, it's almost certain that they will lose money. So they have to set aside a reserve of $5 billion in their capital. This way, if Mr. A does default, at least Bank of America still has those $5 billion to repay Mr. B. That's how the banking system works. And that's why we have the term provision for credit losses. Earlier, I showed you the provision for loan losses, but they also set aside provisions for other activities, such as securities trading. I won't go into detail here, as lending is the most important activity. The total provision for credit losses in 2021 for Bank of America was $11.8 billion. On the other side, they also deduct other expenses, such as taxes, which amounted to $5.4 billion for the entire year of 2021. JPMorgan Chase had to pay $4.8 billion in taxes. And ultimately, Bank of America's net profit for 2021 was $32 billion, and JPMorgan Chase's was $48 billion. Quite impressive, right? As you can see, JPMorgan Chase is better at investing in securities than Bank of America. JPMorgan Chase earned $1.8 billion from securities investment, while Bank of America lost $85 million. It shows that JPMorgan Chase is better at securities investing than Bank of America. And for other expenses, those in parentheses are the major expenses that a bank has to bear. JPMorgan Chase's operating expenses were $20 billion, and the provision for credit losses was $4 billion. Banks are increasingly seeking to earn money from non-lending activities, which they call non-interest income, such as foreign exchange, securities trading, credit card late fees, and selling insurance. You've probably heard stories about people being forced to buy insurance by bank staff to get loans. This is one of the ways banks can earn additional income when it's hard for them to make money from lending. So far, I've taken you through the main sources of revenue and expenses of a bank. I've also shown you the financial statements of the two largest banks in the USA, Bank of America, a state-owned bank, and JPMorgan Chase, a private bank. However, this is only when they are making a profit. What happens in the opposite scenario? If a bank doesn't follow the rules, violates central bank regulations, lends to unqualified borrowers with excessive amounts, or even forges documents and commits fraud to steal money, what problems will they face? Before being exposed, those banks will have to deal with the risks. They might even need the help of the central bank. If there is no way to salvage the situation, the bank will have to go bankrupt. As of today, 4 banks in the USA have been put under special control. These include Bank G, Bank H, Bank I, and Bank J. The reason is that the management of all four banks was prosecuted and imprisoned for violating central bank regulations, engaging in fraud, forging documents to embezzle, and dividing billions of dollars among themselves. The case of Bank One was the largest economic scandal in the history of American banking, as they embezzled $9 billion. Bank J lost $1 billion, Bank G $5.5 billion, and Bank H $3.4 billion. However, in reality, all four banks mentioned have not gone bankrupt and were rescued by the central bank, which bought them back at $0. So if you read news reports or see on TV that they mention $0 banks, it's referring to those banks that the central bank had to buy back at $0 to handle their bad debts. It's not easy to sell a bad debt portfolio. Therefore, banks have to think carefully when deciding who to lend to, how much to lend, and for how long, to maximize profits. The process of lending has to be carefully thought through and planned, and it requires a lot of brain power. Therefore, banks are increasingly trying to earn money from non-lending activities, or non-interest income, such as fee income. That's how the banking system works. And that's why we have the term provision for credit losses. Earlier, I showed you the provision for loan losses, but they also have to set aside provisions for other activities such as bonds. They always have to think about how to allocate their limited funds, which industries to lend to, whether it's to the real estate sector, solar energy, or the consumer credit sector, and for what terms, to maximize profits. This cycle of lending has to be well thought out, and it requires a lot of brain power. Therefore, banks are increasingly trying to make money from non-lending activities, or non-interest income, such as fee income. Reputable banks, especially those at the top, usually offer lower interest rates. If you want higher returns, higher deposit interest rates, you have to choose banks in the middle or lower tiers, and you have to assess the associated risks. If a bank does go bankrupt, deposit insurance provided by the FDIC will cover up to $250,000 per depositor per insured bank for each account ownership category. In reality, if the bank still has assets to liquidate and has remaining funds, they will prioritize paying off their debts, including salaries to employees and interest payments to depositors. I hope this video has provided you with some interesting insights into the banking industry, how they make money, and how the government handles financial crises. Once again, thank you so much for your support. See you next time. Bye.